welcome to TheoTrade. This is Don Kaufman. It's November 8th, 2019, and you are watching the TheoTrade Weekend Update. Theme this weekend? Well, Groundhog Trading Day. What does that mean? I mean, come on, look at the last couple of weeks and you'll understand a little bit more clearly what I'm talking about with Groundhog Day. That is a slow, painful grind to the upside. I mean, hey, listen, this is precisely what we've been terming the negative gamma grind, and it just continues to go on. Now, we are being absolutely bombarded with emails here at TheoTrade. Really persistent. People are like, well, who would ever just turn around and start buying S&Ps at all-time highs? And I've explained this a couple times, but I'm going to take another shot at it. You know, trading firms, big banking firms, proprietary trading firms can and will absolutely be buying markets at all-time highs. But people, it's not what you think it is. For that, I'm going to give you a quick example on the spiders. Okay, so we're going to do a quick example on the spiders. I'm going to go ahead and I'm going to open up an option, just 7 days to go to expiration. So this is an option that expires effectively next week. And I'm just going to give you a real brief example. Let's go ahead and close up this left side bar. And this is, in effect, what causes what we're going to term the negative gamma grind. So this example kind of starts with you. You're going to go out and you're going to do a trade. What trade are you going to do? You're going to go out and you're going to buy, let's say, these 309 calls. So you're going to buy, okay, 309 calls. Now, when you buy those 309 calls, that's going to have position risk. That position risk we're going to call delta. And that delta is going to be what? 46 deltas. But you're actually going to go out and you're going to buy, okay, 10 contracts worth, right? So how many deltas do you have? In this case, you'd be long about 460 deltas. Well, guess what? Who'd you buy those, 309 calls from, huh? Somebody had to sell them to you. Yeah, well, maybe a trading firm did. And the trading firm gets to keep a minute amount of edge between the bid-offer spread. But that trading firm went out and they sell those 309 calls, okay? And what that does is it doesn't produce positive delta. Positive delta means you want the market to go up. This produces negative delta, and it's negative approximately 460 deltas. So let's not worry so much about you right now. This isn't about you. This is about why the market continually and perpetuates an up move. So they sell these 309 calls to who? To you. Now, it leaves them short 460 deltas. The second, literally the second that they've done this, sub-second, they're going to go out and they're going to turn around, okay? They're going to do one of two things. They're either going to buy a futures contract to hedge that risk, or they're going to turn around, for example, and buy, let's say, 460 shares of SPY. They buy 460 shares of SPY. What do? They completely offset the delta. So it creates a delta of 0. Now, if they have fairly good servers and, they're quick out there, they can continually buy and sell shares and buy and sell shares and buy and sell shares just like a mad monkey to neutralize their delta. How do they make money? The edge between the bid-offer spread. That's it. There's absolutely, unequivocally no directional bias. But the point that I'm making with this, okay, and the point that you want to take away from this, you asked why somebody would buy stock or futures at an all-time high. There's your answer right there. It's to hedge off risk. Now, I want you to imagine, okay, you're one of these firms and you're doing this on a global scale. Now, I actually worked for a firm years ago. We would carry positions, people, in the tens, okay, of millions of deltas. So how did you hedge off tens of millions of deltas? You went to none other than, okay, the S&P 500 futures, the E-mini futures. Why the E-mini futures? Because one E-mini future, just one of those, is the equivalent, okay, of 500 shares of the spiders. Now, people, we're having fun. So what do? We go sling a couple of futures. And I'll tell you what, if I was negative delta, I'd be out there buying S&P futures, okay, like crazy. Doesn't matter if we're at an all-time high. I don't care. I still have to mitigate my risk. And then you start to get trapped, okay? And when I say trapped, the more futures you buy, the further they go up. And the further the futures go up. And you see where we're headed? It's the negative gamma grind. That's why it's Groundhog Trading Day. That's what that really amounts to. And what does it take to get out of it? you start to get into this vicious negative gamma cycle. Okay, well, it's going to take a market to actually snap, and when it snaps, oh, you're going to hear it. The next thing I want to bring up on this front is none other than the SPX expected move. Now, with these expected moves, and we've been talking about this week in and week out, the expected moves kind of hand drawn. This is this week's expected move. And I want you to see the marketplace right now still got about 12 minutes to go to the close. It's still open. So the expected move for the following week isn't even definitively set. But this last week, I told you, in no way, shape, or form, don't you dare, okay? Don't you dare sell any option premium of any way, shape, or form, because there's such a high probability of hitting the edge of the expected move. And that's going to be persistent in this next week of trade. I'm going to reiterate the exact same thing. Don't turn around. Don't be selling option premium, okay, in the next week of trade, because that's just going to be downright scary, which you're going to learn here momentarily. But I want you to see the expected moves that we drew. That was the absolute high of the week. It literally tagged the expected move, pulled back in. So, you know, on the week at large, the week started right around 30.67. We're going to end the week somewhere around, 30.87. It's a 20-point move to the upside. It's just an absolute low volatility grind, which is actually perfect to explain, again, that negative, gamma grind. Now, with this, the expected moves, okay, we're tagging expected moves again and again and again and again. There's one thing that I want to continually point out. I'm going to go to the SPX, and again, I'm bringing this up. This is something I typically cover towards the end, but this is important right now, okay? Why is it important? Take a look at the expected move for this next week. Now, as I said, the expected move is not definitive. It's not completely set yet, but look at that. It's all the way down to 30.47. And I'll draw those lines, okay, come this weekend, but it's down to 30.47. As such, you know that the next week's expected move, that's this coming week, okay, it's going to be even lower. And I'm telling you, we are setting ourselves up, okay, for an explosive move outside of what was expected. If you looked back, all right, at a lot of the recent trading weeks, we have a mild breach. Again, a mild breach of expected move right there, and a mild breach. I mean, these are so mild that you can consider them rounding errors. But people, we haven't really heavily breached expected moves since August 2nd. So what occurs in situations like this, we get wound up like a top. There's a huge amount of position risk. You know the negative gamma, is going on. Okay, I'm telling you, there is pent-up aggression inside of this marketplace. Do not be surprised to see that kind of wild 3 sigma move. There's no way to perfectly handicap when a 3 sigma move. And a 3 sigma move, that's a move 3 times, okay, the expected. That would be what? Instead of a $30 move, you'd be looking at like a $90 or even a $100 move. That kind of 3 sigma move, all right, that's what I'm talking about with like pent-up aggression in the marketplace. Listen, you can sell options premium. You could do it successfully. You could do it successfully 7 or 8 times in a row. But it only takes one wicked move to undo all of that work. And that's kind of what we're setting up for in here. So be extremely careful. That's why I talked about the negative gamma grind going on, because, again, it leaves us with some pent-up aggression over there. Next on the platter, bonds getting absolutely rocked. So with bonds getting rocked, I mean, what does that really come down to for you? Anything right now that's interest rate sensitive. And when I bring up the interest rates, let's pull up the TNX. That's representative of the 10-year. The interest rates are, they're taking off to the upside. I mean, basically, you've got the 10-year just shy of 2%. It starts to get over 2%. Okay, you're going to get sector by sector issues over here. What do I mean? Anything that's interest rate sensitive, okay, is going to have issues. Now, I've got trades on specifically inside of the TLT. For those of you that have kind of followed along and played the TheoTrade at-home game, I've got infinity spreads on the TLT. That makes money if we head up, makes money if we head down, and we are starting to see degrees of profitability specifically inside of the TLT. I've got February infinity spread on. That thing is deep in the money. That's a ratio back spread. We start crossing through 133, and that trade is gonna be money. That is going to be a big trade if we get under 133. But I'll tell you, I've been doing this long enough. Okay, it's right when you say something like that, the marketplace turns around. Doesn't matter at this point. I don't care. I have 105 days. Okay, well, realistically, I'm only going to hold that trade in about another 70 days. Nevertheless, okay, I also happen to have the trade on, and it's almost the identical trade, except it's one strike closer for the next, I'll keep this, it says 70 days, but I'll keep this for about another 40 days before I pull it off. All the time in the world. Time to laugh, time to cry, time to see if that trade can actually come to fruition. Again, the bond's getting rocked at this point. I don't mind a bit, and I'm going to talk about, rate-sensitive areas here momentarily. I think what's also on a lot of people's minds, and I really wanted to address this week, is we're going to take a quick glance over at the spiders, and I'm actually going to pull up the spiders, and I'll knock out that working order over there. We're going to pull this up year to date. The spiders are up just shy of 25% year to date. Oh, right, I got ahead of myself and I just rounded it up to 25% year to date. So the reason I brought this up is for the very simple context. All you hear about right now in the news, slowing growth. Yield curve inversions, right? I mean, the whole year we've been talking yield curve inversion. There's a recession coming, trade wars, and low earnings per share. We're passing through earnings right now. We're pretty much to the tail end of some of those earnings, and the earnings, it wasn't abysmal, and it wasn't exactly spectacular either. So with all of that going on, let's be mindful that we're up almost 25% year to date. The reason that I'm bringing this up is in simple respect to, I get, again, tremendous number of emails, just like I was talking about, people asking who would buy at an all-time high. Well, the same people that look at this and think that there's, are there real fundamentals behind this marketplace? And I'm going to make the argument, looking at the spider up 25% year to date, nobody cares. Okay, what we basically have is a low interest rate environment, and the question continually comes up, and I'm gonna throw this one out here for your own consumption and for you to generate your own opinions on. But hey, listen, this incredibly low interest rate environment, and the Fed now lowering multiple times. Okay, the Fed is also involved in repo operations. It's not quantitative easing, but they're involved in repo operations here. They're doing everything they possibly can, okay, to bolster the economy at this point in time. Do you think this is asset bubbles? Okay. Or do you think that this is reality at this point? And I'll leave you with that one to your own devices, because as I actually, position that, now we're actually going to pull up sector comparison. And what a sector comparison is, I think this is going to add a little bit more to the answer of that specific question. When I talk about sector comparison, I'm going to go in here. I've got different styles built. Okay, these are styles that I built, and one of them is called sector comparison. And what sector comparison does, beyond looking like the great spaghetti incident here, a sector comparison, I'm just going to pull it up over 1 year. So let's go in here. Let's go precisely 1 year of time. All you're looking at on here is 1 year major sectors. Okay, major sectors. What's in play right now? What's not in play? First and foremost, year over year. And again, this is year over year to the day. I know a lot of people, they like to, well, let's look at year to date. Let's look at this. Listen, if you change the time frame in here, if I pull up like the last 3 years, okay, you're going to see things look vastly different than, for example, if I were to pull up 1 year. And we'll come back to that here momentarily. Over the last year, the top performer is right there. It's the XLK. It's technology. Okay. The second best performer, and this one shocked me, is none other than the XLU. What shocked me, not that it's one of the best performers out there. What shocked me is how hard and fast this thing is coming down. It's a reflation trade. All of a sudden, tech becomes good, right? And what? Dividend becomes bad. That's what you're seeing over here. And sometimes, and again, the reason I wanted to bring up this comparison, sometimes you need to bring up this comparison because it's going to tell you a whole lot more than just trying to, like, you'll glance at the quotes and so forth. You're like, okay, the emerging market's down, this is up, this is down. Move away from it for a second. Okay? Breathe for a second. Move away from it. Take a look at your sector comparison. What are the underperformers? The underperformance? Energy sector. Energy sector is getting, hammered year over year. But if you look at the energy sector, the last couple of trading sessions, that thing is back up. What else is down there? The XRT, that's retail. No surprise over there. What do we have in here? The XLV, that's healthcare. We'll talk about that here momentarily. Okay, look at the financials. The financials are like the up-and-comer in the last month in here. And we start to zoom in even on a tighter time frame. And you could do that. You can come in here to time frame instead of 1 year. Why don't you bring this up for 3 months? Hit OK. You're going to see how tightly clustered they are together. This is also incredibly important, that the correlation coefficients have really picked up. okay, in a 3-month time horizon, the market is moving much more cohesively, okay, than if you were to look at this, look at over the last 3 years. Now, given more time, obviously you're going to have more spread, but your number one performer over the last 3 years, again, technology. XLK is the unbelievable performer in there, and interestingly enough, energy is still absolutely getting decimated, okay. This can help extensively, and this is something that we have no problem sharing with all of you that are TheoTrade clientele, is for you to actually generate positions over here, because I'm telling you right now in a marketplace, okay, that's in this big negative gamma grind, the opportunity isn't necessarily to get long and to pray that we keep going up. Some of the opportunities, okay, that are really going to be maybe not so transparent are going to be long one sector, short another sector, and we're going to be looking at extensively. That's why I wanted to bring up, hey, listen, you got the S&P's up 25% year-to-date on a year-to-date basis, okay, but year over year, things are not performing nearly as well. And again, one last aspect I wanted to bring up is that you look at stuff on a year-to-date basis, you would see like the XLF ripping to the upside, but the XLF year over year is only up about 9%. Okay, so most of this rally is on a year-to-date basis. Perspective, and again, looking at this comparison can make all of the difference. All right. Next thing we want to move on to stock chop. Okay, I'll cover a little bit more of the sector comparison throughout the course of this next trading week. Specifically, what I'm going to get into this next trading week is detailing where, okay, the avenue that we should probably. There's the closing bell on the day. What avenue we should take, though, regarding which sector we could be long, which sector we could be short, a couple of spreads, a couple of different pairs trading ideas. All right, S&P's, by the way, closed just off the S&P expected move of the week. I'll reiterate that time and time again. Look how close we are to the upper band here in the expected move. People, if you haven't been looking at expected move, you're missing. I mean, you're simply missing it about what's really driving a lot of the order flow. All right, stock chop. What is stock chop? This is actually where I sit down, break down a couple individual stocks. One of the first ones that I want to break down is none other than Costco. I'm actually going to look at what I looked at specifically last week. All of these I carry positions in. All right, all of these I currently carry positions in. Inside of Costco, I'm carrying again and reiterating a bearish position inside of Costco. Costco did break back to the upside over here. Again, I remain in a bearish position. That's a duration position in Costco. Next on the list, Starbucks. I'll reiterate this again. Too late to get into the Starbucks position, but I am maintaining a deep in the money put as a synthetic short stock position. So 2 short positions. Next on the list over here is none other than Cisco. Cisco, it's old tech, but we have to consider earnings next week. Again, I'll continue to hold a bearish position inside of Cisco. A reminder, this is one that we've actually been in since midsummer. So we are looking for an exit on Cisco somewhere in the lower $40 range, anything under about 44 to 43. I would look to exit that. Next on the list over here, Lulu. Okay, Lulu got a nice bid back up this week. That also happens to be none other than a bearish position. Now, the bearish positions that I'm kind of hitting you with here, this is all about risk versus reward. And last but not least on that list is none other than healthcare, the XLV. And XLV, okay, this is one where I'm looking for an opportunity right here, right now from a risk-reward standpoint. Okay, the upside potential looks limited versus the downside risk. All you have to do is open up a little bit more of a substantiated chart in here, and it's all about this last move. Okay, looks almost like the financials. Now, in this coming week, okay, I'll reiterate a trade that I did. But in this coming week, for those of you that do not have this position on, I got cat fever. I'm still talking about Caterpillar to a degree. One of the largest moves on a percentage basis to the upside in recent trading, okay, has been none other than Caterpillar. I've actually created short positions by using none other than in-out spreads. Again, in-out spreads. I also carry duration bearish positions, but in-out spreads, 1 strike in the money, 1 strike out of the money, about 35 days out inside of Caterpillar. One other one that is a real standout. Now here, okay, Caterpillar I have positions in. One of the positions I do not have, okay, is none other than Amazon. This is one, we got to bring it up. We got to bring it up because major technology stocks like your Microsoft and so forth, I just want to compare and contrast for a second. Big tech, Microsoft, knocking out of the park, right? This thing's effectively hitting an all-time high. Apple, okay? Where are we at in terms of Apple? Oh, great, all-time high. We start looking at Netflix. Netflix is not per se like massive tech over here, bid up substantially lately. Even Facebook has actually played a big role, bid up substantially over here. Google, okay? Google, which has not necessarily done great early in the year, is exploding. Again, you have to pull up much substantial, charts to see all-time high in there. Amazon, the odd stock out, well off of its all-time high and struggling at this point in time. That is to be considered, again, for the possibility of a bullish trade. Okay, will Amazon, and again, I'll zoom out for a second, will Amazon play catch up to the upside inside of this marketplace? The other ones that I think are suspect in here, anything, again, that is interest rate sensitive. Again, anything that's interest rate sensitive like XHB. Okay, here's one. Love it. And I want to talk about it. XHB. XLU, which I'm going to bring up next, that chicken is done. But the XHB, this is the home builders ETF. This one where I say, hey, this is what I call kind of the no way out trade. What's the no way out trade? Bonds. If bonds continue to sell off, that is going to take interest rates higher. As interest rates go higher, okay, the not so beneficiary of that move, of course, would be XHB. The home builders are not going to fare well in a rising interest rate environment. So the XHB we expect to go down. Now, what else could happen in the marketplace? Maybe those bonds don't sell off. Maybe those bonds turn around and rally. But if the bonds turn around and rally, that is likely to be because the S&Ps are going to sell off. And if the S&Ps are going to sell off, it's also going to pull down the home builders. I like it. It's a bearish position inside of the home builders. How you want to take that position, whether you use a duration, whether you use an in-out spread, doesn't matter to me. I want to be bearish in there. Last but definitely not least, none other than the XLU. The XLU already getting hammered. I think that the XLU, okay, is really kind of paving the way for what's going to occur inside of the XHB. People, it's a lot to think about on this weekend's update, but it's all about Groundhog Trading Day. And Groundhog Trading Day, low volatility, do not get caught off your game, all right? We're looking now, and again, I want to reiterate this, we're looking now at this next week of trade somewhere below a $30 expected move. And we still have 5 full trading days. Yes, we do have Veterans Day on Monday, okay? However, on Veterans Day, the marketplace is open. By the way, for those of you that are veterans, thank you for your service. The S&Ps are still open on Veterans Day. Nevertheless, it's going to be a very light trading session to be expected, a 5% implied vol. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.